right, welcome back to Financial Clarity for Doctors. I'm Corey Janoff, joined as always by Rachelle Vanderzanden.
Hello.
And today we wanted to talk about investing during scary markets. I think in recent months we've noticed a slight uptick in questions about markets being scary, and is now still a good time to invest, or should we be doing anything differently to prepare for a downturn? And who knows, by the time you guys hear this, we might be in a downturn, or markets might be higher. We might be at new all-time highs. The S&P could cross 7,000. We were so close at the beginning of January, and then it's, kind of fluttered. We're recording this on January 21st, and we usually record these about a month in advance. So not the most timely. If we don't really talk about time sensitive topics, because what's in the news this month is probably going to be forgotten by the time this gets published. But
hmm
I had a conversation recently with a client, had not a lot, but just, a couple questions in meetings, maybe an email or two about, hey, I'm worried that we're in an AI bubble. And when that
hmm
bursts, what's going to happen? Are tech companies overvalued? Are they flushing money down the toilet with these massive AI investments? Are energy costs going to skyrocket? Are we going to destroy the planet in the process? And then there's also the geopolitical side of things, but when is there not geopolitical conflict? Like, let's be honest, throughout history, that's all that it's been. But it seems a little more heightened now, especially like from a US involvement standpoint. We've got Venezuela, there's Greenland, there's the Israel Gaza stuff, Ukraine and Russia, China. Like, it seems like we got our toes dipped in several waters that if you asked someone 5 years ago, they'd have been like, we're trying to take over Greenland. Like, what? um, that's new. But, then, it goes on domestically. Housing is unaffordable. Healthcare is a mess, and on and on and on. You can find negative headlines everywhere you look. I also feel like throughout history, you can find negative headlines everywhere you look. That's just the nature of news. They like to report on the negative things, not the positive things. So, uh, it's somewhat a selected list of headlines. But, speaking of selected headlines, we've got some historical examples for you of, throughout history when markets have been scary and
Yeah.
what's happened as a
Yeah.
result.
I think the biggest, most recent example is definitely COVID. That was really, really scary. And I think it was because like the world was scary, health was scary, and then everyone kind of shutting down and not going to work for a second was scary too. And we expected that that would have a really big impact on the economy. So there are kind of some significant dates and headlines that happened during that time frame, especially at the beginning. Um, Credit to Nick Maguli, is that right? Majuli?
Julie, I think, is how. So he has this
Yeah,
blog of dollars and data, and one of his
Majuli.
recent articles was
Had all the
the,
dates.
the premise was like, hey, if I could give you what events are going to happen in the future and tell you to invest based on those future news headlines, when would be the optimal time to invest? Even if you
Yeah,
knew the future events, you still probably wouldn't get it right from a timing the market standpoint.
yeah. It's kind of funny how well I remember this. So March 11th, 2020, which was a Wednesday, the WHO declares that COVID is a pandemic, a global pandemic. The NBA cancels their season.
I
That's what
was
it felt
watching that
real,
too.
real.
Like the
Yeah.
refs running out on the court right before tip off, blowing his whistle, like Rudy Gobert has COVID. Everyone evacuate. And it was like, holy smokes, this
That,
just got
yeah,
real.
canceling basketball. What? Like that felt very real.
And
So
then the
that
next
was,
day, the college players were still playing games. It was kind of
yeah,
comical.
that weird like Wednesday through Friday time frame was definitely weird. I remember by that Friday, like at least in Oregon where we live, like all the schools were canceled. We got an email from our preschool that they were closing down. It was like done. There wasn't really like it was very open-ended how long everything was going to be closed. I remember that it was a Friday the 13th in March. So March 13th of 2020, all the schools got closed down. It snowed here in Portland, which is super weird. And Colette had her first taste of pistachios, and it turns out she's allergic. And so she was vomiting all over. That was my Friday the 13th at the beginning of COVID.
Man, like forget COVID. We got a nut allergy. This is more
That
pressing.
was a weird day.
I remember we had a quarterly meeting and we were like, uh-oh, what do we do? Like, let's buy laptops for all our staff and send them home because we can't make them come to work on Monday
Yeah.
with what's going on.
Yeah. I remember we were at like a small business, like big party that week. I think it was like Monday or Tuesday
Yeah,
at
we
the
had
convention center.
we won some
Yeah.
award for like best companies in Oregon.
Yeah.
And it was
And
like,
I
yeah,
remember even then that Monday or Tuesday looking around being like, why are we at the convention center? I remember there was a bartender and I got a beer and he like coughed to the side and I was like, no, I don't think I want that beer. Why am I here? Okay, anyway, so all of our COVID remembrances. Moving on with the
this
stock
was
market.
March,
This
March
is
10th,
March, early
11th, 12th,
March.
13th. Yeah,
Yep,
you all probably have stories of where you were, what was happening, all the
absolutely.
PPE gear they were sending you to put on at the
Yes.
hospital,
Oh, we should
coming
not
in
even talk about
hazmat
our drama
suits.
because your drama was so much more than ours. Yes. Okay. April 10th, the US surpassed Italy as the global hotspot for COVID. Yay for us. That's terrible. May 28th, the US death toll from COVID surpassed $100,000. So this is like everything. It was
100,000
serious,
people.
like 100,000 people. Yes. So that was a big deal. September 28th, the worldwide death toll surpassed a million, and the US death toll surpassed 200,000. And as of December 14th, the US death toll surpassed 300,000, and then vaccines begin to be administered outside of clinical trials. So we start to see some vaccines out in the world. Obviously, it took a while to produce and manufacture and get those out to people that needed it. And then February 21st, 2021, the US death toll exceeds 500,000. June 1st of 2022, the US death toll surpasses 1 million. So like maybe the rate of infection and death kind of like slowed down, but we're still experiencing some pretty serious things. The market peaked. So this is where we come back to investments. The market peaked in late February of 2020. And then as stuff started to hit the fan, as people started to realize how serious this was, the market hit bottom in late March. So after all the shutdowns started happening, we started seeing some pretty dramatic pullbacks like daily. Like it was just like it's
Like
down, it's down, it's
10%
down, it's
swings up
yeah,
and down.
like
It was insane.
wild. And then, so late March,
March
everything's
23rd, maybe was the bottom.
yeah, everything is wild. Like people are very worried about the housing market, the stock market, the economy, people not having jobs, people not being able to afford to pay their bills. And it was very dramatic. But the wild thing is that in the midst of everything that was happening, the stock market recovered in 2020 and rose and was hitting new highs about 5 months later on August 18th of 2020. So even while everything was still happening, people were still getting sick, but people were also getting back to work and things like that and figuring out new ways to kind of mitigate their risks and mitigate risks for other people. Um, yeah, it was just like, oh, this isn't going to be as big of an impact to the economy as we expected. And the stock market recovered very, very quickly. And I think a lot of it, especially in the domestic market, was probably partially because the government was pumping a lot of money into the economy by giving people like the COVID relief checks, but also by lowering interest rates. Like all of that pushes a lot of money into the economy and kind of props it up and holds it up. And therefore, the stock market was like, oh, this isn't going to be so bad and came back.
But even with like all the stimulus stuff, there were definitely a
Mm-hmm.
lot of people that were like, this isn't enough. Like giving people a
Yeah,
$1,000 checks, like, okay, that helps, but that's not gonna
pay my
last.
rent.
Yeah.
Mm-hmm.
There was a ton of stimulus. I think it was like 8 trillion. Does that sound right?
I don't
Like
even
total.
remember.
Whatever the number
Yeah.
was. So yeah, government propped us up a lot, but it was still scary. And we, left out some headlines in there of like, vaccines come in, mask mandates, elective procedures still weren't open at that point. But basically, when the news was
Yeah.
darkest in March, that's when
Mm-hmm.
things hit bottom. And the news headlines weren't much better for the next couple of years. Like remember on the news, they'd have the COVID death count tracker.
Mm-hmm.
It was like at
Yep.
school, you have the fundraising thermometer like that. We were doing that with people dying, and every night Fauci's on the news, and it was like must see TV. Um, Market was ripping and roaring at that point. Like the news
Mm-hmm.
was terrible, the economy was,
So
but
so.
like there were people out of jobs, there were people on furlough, who knows what was happening. People were dying. Like, is it ever going to get back normal? Can restaurants reopen? Can, we had the distancing, the like you can only have so many people in the restaurant. We had the to-go orders. I think one of the best things that came from COVID was the like pull up and they drop the food in your car. And same with like Target order pickup and stuff like that. You don't even have to go in, they just bring it out to you. Um, but like all along, the investments turn the corner way before the news turned the corner. And if you'd been making investment
Hmm.
decisions based on news headlines, you'd probably still be concerned and hesitant to invest multiple years after the bottom. Like from March 23rd, 2020 to June 1st, 2022, headlines were awful, but the S&P rose about 80% over that 2 year span, a little over 2 year span. And you would have missed out on almost doubling your money had you either not invested or pulled out and or waited on the sideline. So
Hmm.
the whole point is impossible to predict how the markets, how your investments are going to react based on what the global events are, what the news headlines are.
Yeah. If you could predict, you would have bought a whole bunch on March 23rd, 2020, if you were able to. But,
And
you
you
know,
would have been thought of as insane at that point. Like we just
maybe,
rattled
yeah.
off headlines of, how bad things were, death tolls, like, and that's not even the half of it, like all the negative news that were out there. We had the George Floyd protests and riots in the streets. We had like
Yeah.
Portland literally on fire and burning down.
In Seattle.
Um,
Hmm.
Seattle, like it's yeah, it's impossible to predict, impossible to correlate. All right, how are investments going to react based on these world events happening?
Yep. Housing bubble. That was another one. Ooh. I always think of The Big Short and Michael Berry and all that kind of Burry, I think. Yeah. Anyway, so the global financial crisis and the housing bubble that kind of preceded it, at least domestically. So that was one of the biggest or the biggest economic collapse since the Great Depression in the 1930s. So the economy struggled for several years after that, which started in 2008. So the stock market kind of peaked in October of 2007, bottomed out in March of 2009. So a very, very different market pullback, where in COVID, it was like dramatic and fast and kind of turned around quickly. With the global financial crisis, it was like down, 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 over a full year and a half. And then the market had stellar years, great years in 2009, 2010, 2012, 2013, and a lot of other years, except like 2022 wasn't a great year. But really, like we've been on a roll in the domestic stock market, especially since 2008 and, starting after March of 2009. So that's a big deal. That was the biggest financial meltdown in our lives. We didn't live through the Great Depression and things like that. There was a 17-month drawdown before it came roaring back for the next 15 plus years. Part of what made this like so, so hard for people. And it's like it came kind of on the heels of that dot-com bubble. So a lot of investors were still recovering from that. And then there's another pull down, and you have that on top of it. And especially if you were approaching retirement age and things like that, like that was a big deal. That was a pretty significant decrease in the stock market and things like that.
And the economy was in the pits for a number of years. Like it
Yeah.
wasn't just, oh, 2009 bottom, now we're back. No, like 2009, 2010, 11, 12, like it was rough for
The
the
housing
economy.
market took a long time to come back too. It was like
Oh yeah.
yeah, like prices came down and it took a long time for houses to get back to the prices that they were kind of pre-housing bubble, et cetera.
Like
Yeah,
I bought my first home. It was a condo, foreclosed, bank owned at the end of 2010. I think it officially closed maybe January of 2011.
me too.
And I could have like walked down the street and had my pick of foreclosed properties. Every other property for
Yeah.
sale was bank owned, foreclosed, and they were just taking losses left and right. And I think when I refinanced my mortgage in 2012, because rates came down even further, I think my first mortgage was like 4.5%, and then I refinanced to like three and a quarter, maybe. Um, and it appraised at like 10 or $20,000 less than it appraised at when I bought it. I think when I bought it, I paid like 160 something, and it was appraised at 190, and the bank was just like, "Forget it, we don't want this, take it." And then when I did the mortgage, I think it was appraised at 180, I want to say, when I refinanced a couple years later. So like
Yeah.
even in like 2012, economy was still, especially housing and whatnot, was still struggling. I think it was maybe 2013-ish that we started to see some noticeable pickups, and unemployment was noticeably dropping. But there
Hmm.
there was a good stretch there where it was rough. But the investments, again, we're we're trying to separate what's happening in the world, what's happening in the economy from what's happening
Hmm.
with your investments. And it's impossible to predict. I mean, sure, there might be some correlation, but your investments are generally forward looking, and typically rebound and recover sooner and faster than the news headlines do. You mentioned that the lost decade, early 2000s, we had the dot-com bubble pop, and stocks went basically on a 3-year slide, 2000, 2001, 2002, where S&P was down every single year. And that was probably more painful because it's like you had
Yeah.
3 consecutive years of losses.
Yep.
And it's like, ugh, this sucks. Like, am I
Yeah.
ever going to make money in my investments? So that was probably one of the roughest periods for people to invest in like modern times. I mean, most of you listening probably were still in school at that point in time,
Hmm.
but ask your parents like, hey, what was it like investing in the early 2000s? And it was not good because everything was going down. Now, if you were well diversified, if you had
Hmm.
international stocks, if you had emerging markets, if you had bonds, if you had real estate, commodities, precious metals, like you would have been all right. International stocks did fantastic in the early 2000s, mid 2000s. Real estate, housing bubble, real estate was like doubling year over year for a lot of investors. Gold hit record highs at the time. Now it's like even more insane record highs.
Hmm.
So like if you were diversified, even though US stocks struggled, like you would have been making some money on your investments. And if you were dollar cost averaging, like we talked about last time, um, you would have been buying at low points and
Yep.
realizing those gains as they came to fruition. So,
Yep.
um, Great Depression, you want to go all the way back to there?
Sure. Why not? One more thing about like, I don't know. So we don't want to try to time the market, but can you imagine being a person who was just getting started investing in like 2008? They probably feel really good right now. Because they like started buying it at a low point and then, you have this 15-year run of just great performance. Like that probably feels pretty good. So even when there are downturns, especially when you're a young investor, it's like, it's an opportunity when you're buying at that point. So that's not a bad thing necessarily. Okay. With the Great Depression, Andrew Ross Sorkin recently wrote a book called 1929 that sparked some parallel comparisons from the 1929 crash and to today. So many of the financial regulations and protections in place today were created as a result of the 1929 crash and the Great Depression of the 30s. And things like FDIC insurance. So there aren't bank runs. Like that was one of the things that came out of that. The SEC created that to oversee trading, and well,
The
the
SEC
SEC was
was created.
created, yeah, as a result of that to oversee trading and enforce rules and things like that. So our industry is very, very regulated, partially because of some things that happened during the Great Depression. So it also just kind of separates commercial and investment banking. Like that's separate from like you as an individual putting your money in US Bank and having it in a savings account. Like those two things shouldn't be conflated. Like your bank account assets should be protected. The Federal Reserve was also granted the power to set interest rates, which is really interesting, especially in today's kind of headline environment. And it allowed, for emergency government loans to banks and things like that, which we've seen in the last few years. We had a couple of small banks kind of fail, basically, but the government was able to sweep in and kind of support those banks. But maybe ultimately the banks didn't survive and were bought by other banks, but their customers were kept whole. So your bank account balances at First Republic, for example, if you had bank account balances there, like you didn't, that money wasn't lost. It wasn't gone because of FDIC insurance, but also because of government support, even above and beyond those FDIC insurance limits.
I mean, you
So
look
lots
at
of
the
things that are safer.
bailouts from 2008, the
Yeah.
COVID stimulus money, like that wouldn't have been feasible had we not had the Great Depression, and the stock market crash of 1929. So a lot of the stopgaps, a lot of the protections in place, I think that's where different diverges. I think that in his book 1929, he talks about some of the parallels and valuations and businesses and blah blah blah. But I think that's probably where it stops in terms of comparisons. In my opinion, there's so many more protections in place and investor protections nowadays that, not saying we can't have market crashes or major market declines, but with the way the system is structured and built, I think that's why you've seen in more recent years when we have had, economic events, the market's recovered in a hurry because of the interventions that can be implemented, because of the protections that are in place. I mean, remember a couple of years ago we had, the banks, the Silicon Valley Bank failed, and there was a couple other small to mid-sized banks that failed, but government stepped in right away, nipped that in the bud, so it wouldn't be a domino effect throughout the
Hmm.
banking industry. And not saying that like they've set a precedent that, oh, if the bank's gonna go out of business, if there's a run on a bank, the government's gonna guaranteed to step in and protect everyone. Like, not guaranteed, but they've shown that they will do what they can within their power to prevent it, becoming a more widespread issue throughout the entire economy. So during COVID, things rebounded in a hurry. 2022, one of the worst years in modern history for investors. Both stocks and bonds were down double digits. And most of you might not even remember that, even though it was only 3 years ago, 3.5 years ago, because it was, like, think we're at new all-time highs at this point in time. So I
Hmm.
think we've got the weighty evidence of history. Obviously, no guarantees moving forward, but up to this point, markets have always rebounded after they declined. Um,
Hmm.
that's if there's anything that, it's kind of like the sun rising. Sometimes it takes longer than others for the markets, but they've always rebounded and recovered to new highs. Typically, the markets turn positive well before the news. I mean, is the news ever positive though? Like,
I mean, you have to dig for good news.
yeah,
The headlines that get splashed around are generally not good. And then, like if you're like, oh, I want to look into something a little more positive, you can find it.
yeah. Like there's like,
Mackenzie Scott just gave away a bunch more of her money. Every time I see something about her, I'm like, that lady, she's the best,
there you go.
Like,
And there's feeds and channels like what the Good News Movement that only
oh, for
publishes
sure.
positive
I think that
stories.
happened during
Yeah.
COVID too, is that, people were like, yes, this is concerning and this is horrible and this is, very, very sad and like very challenging time. But also like there are still good things happening in the world. And you would see that during COVID, I feel like a lot. Like there was a lot of like comedians and actors and things like that were like, yeah, while acknowledging that this is like not good, we also want to talk about these other things that are kind of amazing that are happening.
I mean, flip it on its head, the whole AI bubble thing, like all the concerns about AI displacing humans, ruining the planet, blah, blah, blah. Look at all the positives that are coming from it. You got to dig a little bit, but it's making people way more efficient at work. All the medical innovation that could come from this, like being able to potentially solve and come up with cures for diseases and help improve diagnoses. Is that the right word? Diagnoses?
Diagnoses, I think.
Diagnoses.
I don't know.
Um, like I think I'm of the opinion the positives probably will outweigh the negatives. I mean, like, remember a handful
Mhm.
of years ago, 3D printing was all the cool craze, and like now they're literally 3D printing prosthetics. It's not making news headlines, but you can get customized like anything pretty much now for you know
Not very
like,
much money, too. It's a
yeah,
pretty
it's become a
affordable
lot more
process.
expensive. Yeah. So I think it's
Mhm.
going to bring costs down for a lot of things. It's going to help make things more efficient, more customized for people. Like, you know, 20 years ago, how long did it take to decode your genetic makeup? Now it can be done almost instantaneously. And then you throw AI into the equation, it can come up with what solutions and treatments might be optimized for your specific circumstance. You guys are probably way more knowledgeable than Rochelle and I in this arena and probably know all the drawdowns and roadblocks and pitfalls that are involved in it. But I think it's only going to get better and more efficient as time goes on. So, but you got to seek out the positive. That's not the leading headline. It's not even below the fold. It's on like the back page of the paper that you got to flip through before you can actually get to that article. So you got to go out and find the
Good
positive
news
news.
doesn't sell. Like bottom
No.
line, good news doesn't sell. They're making money. They're all the news outlets, like how many are nonprofit? Like a handful, right? So generally they have to pay their bills too. And the big splashy headlines are not generally positive ones.
But even nonprofits, like they need eyeballs to
Yeah,
attract
to
attention
function.
and to
Yeah.
get advertisers and donors and whatnot to help support their mission. So
Hmm.
like they're gonna want to publish
Yep.
the stories that get the clicks too.
Yep.
Um, anyways, what do we do here as an investor? If we're concerned about where we're at in the state of the world in the stock market, like, hey, I'm worried about my investments. What do I do?
Diversify. Period. I mean, you don't want to have all your money in tech stocks. You don't want to have everything in like one thing or the next big thing. Like, especially if you're a person that's worried, like that's not the thing that you should be doing. So don't throw it all in tech stocks. Don't throw it all in crypto. Whatever you think might be the best thing. Whatever, like, even if you're like, this thing seems safer to me, don't put it all in that. Like, that's not the goal here. The goal is to diversify. So if you have a long time until you need your money, i.e., like, you're in your 30s and 40s and you are going to plan to use this money for retirement in your 60s, then write it out. Probably don't look at least every day. Like check on it once in a while. It makes sense to be informed. But if you're looking at it every day, you're probably looking at it too much. Don't watch the news if you're looking for like stock market advice. Like,
Just don't
no,
watch the news, period. Like
no,
there's
Corey,
nothing
I
good
disagree.
that
We could
comes from the
argue about this.
news.
Let's
Go
get
outside,
down
get
to
some
arguing.
exercise.
I think being informed is important, but everything has limits, especially if it's stressing you out. You got to take some me time. But yes, also take a walk, do some yoga, have a glass of wine if that's your thing. So, I mean, you've got to find a way to decompress and not let it lead you to make emotional decisions about your investments because the stock market is not going to do what you think it's going to do in any given moment. So if you need money soon, though, and this is very, very important, if you need money in the next 1, 2, 3, maybe even 4 or 5 years, it doesn't really belong in the stock market or even necessarily in the bond market. Like it's a little bit less volatile than the stock market, but if you want to make sure you have a chunk of money in a certain period of time, and that time period is fairly short, the best place for it is going to be a place where it's not subject to the ups and downs of a market. So we're putting it in like a high interest savings account, maybe a certificate of deposit, like things like that, where like maybe we can earn a little bit of interest, but there's not the same kind of risk that comes with being invested. So don't put your money in a place where it's going to cause you worry because you need it in 2 years. Like that's just not an appropriate strategy in that kind of scenario.
Nothing that potentially could go down. So like if you want to buy a
Exactly.
2 year, if you need the money 2 years from now and you want to buy a 2 year treasury bill that's paying, I don't know what they're at, 4% or so right now. It's like, great. Unless the US government defaults on their debt and can't repay their debt holders, which probably have bigger things to worry about if that's the case. You're getting your money back plus that interest in 2 years' time. So now is that 4% on the treasury bill going to make that much more of a difference than the 3.5% you're currently getting in your high yield savings account? I don't know, probably not. But depending on how much it is, like if you're saving up for that home down payment, and you're putting 100, 200, 400, 500,000 in there. All right, well, an extra 1%, that could be, a new couch, TVs for every room in the house. Like,
Yeah.
it adds up, but it's probably not changing your ability to buy that home. It's the short term, we're more concerned about the return of our money than the return on our money. Um,
So cheesy. I love it.
Whereas long term, though, your biggest enemy is inflation. Eh,
Hmm.
30 plus years from now, cost of living is going to be more than double what it is today, just due to inflation. Like if inflation averages 3%, which is a little actually less than the historical average, but let's just call it 3% average inflation, cost of living doubles every 24 years at that inflation rate. So
Hmm.
you need your investments to grow faster than inflation over time in order to maintain your standard of living throughout your life. And the only way to do that is invest in things that have the potential to grow. So,
Hmm.
companies, basically, stocks. Um, and public or private, there's opportunities. If you own a business, or private equity now is becoming way more accessible to everyday investors. And there's other things like real estate, et cetera, but essentially something that produces positive cash flows. Um, so it has revenues that are greater than their expenses, and you can either live off of that income or reinvest that income to compound it over time. So,
Mhm.
uh, other considerations. So aside from just grit your teeth, tough it out, don't worry about it, easier said than done. If you're still not going to sleep well at night, we probably do need to revisit how we're investing that portfolio. Having a plan in place that's going to allow you to follow through with it, because this is all great, in theory, but if you're not able to stick with it, it's not going to work. It's not going to help you in practice if you can't survive the ups and downs emotionally or mentally. So if it really is concerning to you, there are things that you can do to help protect yourself or mitigate some of those downside risks. For example, annuities, sometimes a dirty word in the investor landscape, but there's a reason they exist. They serve a purpose. They're designed to provide guaranteed minimum income streams. Typically in retirement years, but you could start it in theory before you retire if desired. Um, so it's the whole point is I'm going to take this chunk of money, put it in an annuity, and I know no matter what happens in the world around me, no matter what happens in the markets, I'm guaranteed to have at least this much every year for the rest of my life. And
Mhm.
if you plan to live a long, healthy life, that could work out very favorably for you, especially if you do like a joint life annuity where it continues to pay your spouse after you pass away, or vice versa. There's going to be guaranteed income for both of you until the second person passes. That can be very appealing for some folks. Like, hey, I'm nervous about my retirement nest egg going down. I want to make sure I have at least something coming in on a regular basis. That serves a very good purpose, probably more emotionally than financially, but obviously financially as well. Structured notes. We've talked a little bit about this before on previous episodes, but they come in all sizes and flavors, but you can get ones that are designed to provide downside protection while still benefiting from upside participation in the market. So if the market goes down, you're not down as much. If the market goes up, you still get the upside. Now, there's catches, like your money's
Mhm.
tied up in this note until the note matures. So if it's a 2 year, 3 year, 5 year note, whatever, like plan on not touching that money for that time period. They're typically not the most tax favorable, so you're not going to have preferable tax treatment on that. But whatever, like if again you're more concerned about getting your money back than the return of it, or the return on the investment, well, this kind of gets you. You're going to get some return. You might have to pay a tiny bit more in taxes if the return's positive, but whatever. That's a fair trade off if we're
Mhm.
worried about declines. Um, Buffered ETFs are basically structured notes packaged into an ETF wrapper, and typically they have a downside buffer and an upside cap. So, like you might have for example, an S&P 500 note that over a 1 year span has a 15% ceiling and a 15% buffer, meaning if the market's down 20%, you're only down 5, but if the market's up 20%, you're up 15. So you're collaring the ups and downs, making it a little more predictable. Um, Index life insurance, another one that has a floor on the cash value and there's a cap on the upside. But again, you're not going to lose money due to market performance. You can only see positive growth there. Now, there are costs of insurance that, generally speaking, will make this, um, all else being equal, you're probably going to do better in a quote unquote normal investment account over time because you don't have that cost of insurance component. However, you also have the downside risk in the normal investment account. So trade-offs with everything. Do we want to sacrifice a little bit of upside in favor of downside protection? And there's numerous ways to do that. We haven't even gotten into like call and put option strategies, but we can maybe save that for another time.
I think so. I think with all of these kind of alternative strategies, like it doesn't have to be all or nothing. We're not talking about like you take your entire investment portfolio and you put it all into an annuity or a structured note or whatever. It could be like, okay, it will make me feel better if 20% of my investments are safeguarded a little bit in one of these types of products. So, like whatever it is that like kind of helps you feel like your financial plan is structured with a little bit of downside protection. And those are where those can come in and could be really helpful potentially, especially as you approach retirement age. I think that can be helpful for people who are very concerned about running out of money and things like that.
Yeah, pros and cons to everything. Obviously, case
Hmm.
by case for everyone. If it makes sense, talk with your advisor. Is make sure you kind of understand the good and the bad of it, what the trade-offs are,
Hmm.
um, so that you
Costs.
can determine if this is an appropriate tool to help you sleep better at night and achieve your long-term objectives.
Absolutely. Well, thank you for listening, everyone. I hope you're keeping your chins up and not too worried about your money.
There we go. And we will see you next time.